When we think of a banking crisis, we usually picture panicked depositors lining up around the block to withdraw their savings. But right now, a different kind of credit crunch is unfolding, and it is completely silent. This diagram shows the immense scale of what's known as private credit, a $3.5 trillion shadow banking industry. These funds essentially act as non-bank lenders, providing money to companies that are generally too risky to borrow from traditional banks or public bond markets. For years, money poured into these funds, but lately the tide has turned. Wealthy investors and major institutions are suddenly asking for billions of dollars back. Instead of handing over the cash, many of these funds are enforcing withdrawal limits. They are legally restricting how much money investors can pull out during any given quarter. This creates a severe structural mismatch. Investors are demanding instant access to their cash, but the fund's money is tied up in long-term corporate debt that cannot simply be sold off overnight. To see how all that capital got trapped, we have to look back at the era of near-zero interest rates. Desperate for yield, investors flooded this market, causing direct lending to skyrocket from roughly $40 billion to over $650 billion. With so much money chasing a limited number of suitable borrowers, lending standards inevitably weakened. As industry experts from firms like PIMCO have noted, this rapid growth created imbalances, encouraging funds to finance increasingly risky, highly leveraged software and tech companies. That massive debt load was manageable only as long as borrowing remained cheap. Then, benchmark interest rates rose. This chart shows exactly what happens to those companies. Many private credit loans use floating rates, meaning the interest bill is tied to the broader market. When the benchmark rate goes up, the borrower's required monthly payment shoots up right alongside it. A company that could comfortably handle its debt 3 years ago is now suffocating under these higher payments, without actually earning any more money to cover the difference. Normally, a borrower running out of cash goes bankrupt, but the private credit market utilizes a specific maneuver to delay that outcome, known as a payment in kind, or PIK, arrangement. This diagram shows the mechanics of a PIK. If a company can't pay its interest in cash, it simply adds that unpaid interest onto the total amount it originally borrowed. The borrower avoids an immediate formal default, but their actual debt obligation grows larger. You don't see panic in the broader markets because these agreements happen entirely behind closed doors. A publicly traded bond changes price every day based on reality. A private loan does not. Private credit funds can keep valuing these distressed, bloated loans close to their original price, right up until a company is forced to refinance or file for bankruptcy. Between the payment-in-kind arrangements and the opaque valuations, the market maintains an illusion of stability, effectively hiding a massive accumulation of deteriorating debt. Private credit is widely known as shadow banking, implying it operates completely outside the traditional financial system. But regulated banks actually provide the massive lines of credit that these private funds rely on to execute their deals. That connection is where the actual danger lies. Europe's largest bank, HSBC, recently absorbed a $400 million loss directly connected to the collapse of a lender. In response, HSBC is actively adjusting its exposure. The bank is reportedly informing clients that it will not renew lending facilities for private credit funds that do not offer sufficient returns to justify the growing risk. Banks generate revenue by accepting carefully managed risk. When a major global institution decides that entire categories of lending should be cut off, it signals that the hidden danger inside these portfolios has finally outweighed the reward. Right now, this is the first domino falling. When traditional banks cut off the money, they begin a systemic liquidity drain that forces shadow funds to operate with far less capital. As the banks pull back their credit lines, private funds have less money available to deploy. With limited capital, those funds naturally reduce their new lending. This leaves heavily indebted businesses with no available cash to refinance their mounting payment-in-kind obligations. This flowchart shows how the contagion spreads. The traditional bank withdraws credit, the private fund's liquidity dries up, and the corporate borrower defaults. At that point, the private valuations shatter, and both the funds and the connected banks take the losses. This is distinctly different from the 2008 mortgage collapse. You won't see retail depositors losing their checking accounts or ordinary homeowners defaulting on a massive scale. The next banking crisis will not begin with a loud, sudden crash. It is beginning quietly, right now, as evaporating credit slowly strangles the businesses that rely on it to survive.